Everyone is watching the S&P 500, but almost nobody is paying attention to the part of the market that's quietly outperforming it by the biggest margin in over 2 decades. Here's what's strange. While millions of investors continue pouring money into America's biggest companies, another corner of the stock market has been steadily pulling ahead without attracting much attention. The surprising part isn't just that it's outperforming. It's happening while the S&P 500 is trading near some of the highest valuations in modern financial history. That raises a much bigger question. If the most popular investment in the world is becoming more expensive every year, where could the next decade of outsized returns actually come from? Today, we're going to explore one of the most overlooked opportunities in the market, the Russell 2000. This index tracks approximately 2,000 small American companies that rarely make headlines, yet history shows they have often delivered exceptional returns after long periods of being ignored. Before you dismiss small-cap stocks as too risky, it's important to understand why professional investors are suddenly paying attention again. This isn't about chasing the latest trend or predicting a market crash. It's about understanding valuation, market cycles, and how long-term wealth is usually created. Markets move in cycles, and every cycle eventually creates new winners. For years, mega-cap technology companies dominated nearly every conversation about investing. Companies like Apple, Microsoft, Nvidia, Amazon, Alphabet, and Meta generated extraordinary returns, pulling the S&P 500 higher and rewarding investors who stayed invested. But success has a cost. As more money flowed into those companies, their valuations climbed higher and higher. Eventually, investors were paying significantly more for every dollar of earnings than they had in previous decades. History suggests that when expectations become extremely high, future returns often become more modest. Meanwhile, many smaller companies were left behind. They received less media coverage, attracted fewer investors, and in many cases continued growing their businesses while their stock prices failed to keep pace. That gap between price and business performance created something investors always search for: potential value. In 2026, that story began changing. Small-cap stocks quietly started outperforming large-cap stocks by one of the widest margins seen in more than 20 years. Most people didn't notice because financial headlines remained focused on artificial intelligence, trillion-dollar technology companies, and record highs in the S&P 500. But beneath the surface, capital was slowly rotating toward businesses that looked cheaper and offered greater long-term upside. This kind of rotation has happened before, and every time it has, investors who recognized the shift early benefited the most. Of course, none of this guarantees that history will repeat itself exactly. Markets are unpredictable, and no investment is risk-free. Small-cap stocks are naturally more volatile than large-cap stocks, and they can experience larger swings during economic uncertainty. But volatility alone doesn't determine long-term returns. The price you pay for an investment often matters just as much as the quality of the investment itself. That's the central idea we'll explore throughout this video. We'll look at why valuations matter, what history can teach us about previous market rotations, why some experienced investors believe small-cap stocks may finally be entering a new leadership cycle, and, most importantly, how an ordinary investor can take advantage of these opportunities without trying to predict every move the market makes. By the end of this video, you'll have a clearer understanding of whether the Russell 2000 deserves a place in a long-term portfolio or whether the S&P 500 still remains the smartest choice for building wealth over the next decade. Let's begin by looking at the biggest problem facing today's market, a problem hiding in plain sight that almost every investor is ignoring. The biggest challenge facing investors today isn't a lack of great companies. It's the price they're being asked to pay for them. Imagine walking into a dealership where every car is selling for twice its normal value. The cars haven't changed. Their engines are the same. Their performance is the same, but the price has doubled simply because everyone wants to own one. Most people would immediately recognize that's not a great deal. Yet investors often do the exact opposite in the stock market. When prices rise, demand increases, excitement grows, and people become more willing to pay almost any price just to avoid missing out. That's exactly what has happened with large-cap U.S. stocks over the past several years. The S&P 500 remains one of the greatest wealth-building investments ever created, and for most investors, it has been an incredible long-term performer. Warren Buffett has recommended low-cost S&P 500 index funds for decades because they provide broad diversification and eliminate the need to pick individual stocks. But even Buffett has repeatedly emphasized one simple idea: price matters. Buying an outstanding business at an unreasonable price can produce disappointing returns, while buying a good business at a reasonable price often leads to much better long-term results. This is where valuation becomes incredibly important. Valuation doesn't tell us what the market will do next week or next month. It tells us how expensive today's expectations already are. One of the most widely followed valuation measures is the price-to-earnings ratio, or PE ratio. In simple terms, it measures how much investors are willing to pay for $1 of a company's annual earnings. A higher PE means investors expect stronger future growth. But when expectations become too optimistic, even great companies can struggle to deliver returns that justify those prices. Another widely respected measure is the Shiller CAPE Ratio, which averages inflation-adjusted earnings over 10 years to smooth out temporary booms and recessions. Historically, extremely high CAPE readings have often been followed by lower long-term returns, not because businesses suddenly became bad, but because investors had already priced in years of future optimism. The same idea appears in another famous metric known as the Buffett Indicator, which compares the total value of the U.S. stock market with the country's economic output. While no single indicator can predict market movements, together they paint an important picture. When multiple valuation measures simultaneously suggest that stocks are historically expensive, future returns have often been more modest than investors expected. This doesn't mean a crash is guaranteed. Markets can stay expensive for years. Strong corporate earnings, technological innovation, falling interest rates, and investor confidence can all keep valuations elevated longer than anyone anticipates. That's why experienced investors rarely try to predict exact market tops. Instead, they focus on probabilities. When prices are unusually high, future returns tend to become less attractive. When prices are unusually low, future returns often improve. This simple principle has repeated itself throughout financial history. During the dot-com bubble of the late 1990s, investors believed technology stocks could only move higher. Many companies with little or no profit traded at extraordinary valuations simply because investors expected unlimited growth. Eventually, reality caught up with expectations. Some companies survived and became global giants, while many others disappeared entirely. The lesson wasn't that technology was a bad investment. The lesson was that paying too much for any investment can reduce future returns. That same principle continues to apply today. Instead of asking which companies are the best, smart investors also ask whether those companies are still reasonably priced. And that's exactly where small-cap stocks begin entering the conversation. While most investors focused on the largest companies, many smaller businesses quietly traded at much more attractive valuations. The gap between large-cap and small-cap pricing has widened to levels that historically attracted long-term investors looking for value rather than headlines. The question now isn't whether the S&P 500 contains great companies. It absolutely does. The real question is whether the next decade will reward investors who continue buying what's already expensive, or those willing to look where fewer people are paying attention. The Russell 2000 is becoming interesting because small-cap companies have been ignored for years, while mega-cap tech stocks dominated the market. History shows market leadership changes over time. Small-cap stocks carry higher risk and volatility, but they often trade at lower valuations and have greater growth potential. Instead of trying to predict market tops or bottoms, successful investors focus on investing consistently and letting compounding work over the long term. Russell 2000 ETFs offer an easy way to invest in hundreds of small businesses without picking individual stocks. However, there are no guaranteed returns, and small-cap investments can experience sharp price swings. The key is understanding your risk, staying patient, and avoiding emotional decisions. Many investors chase stocks that have already performed well while ignoring opportunities that seem boring today. Long-term wealth is built through discipline, consistency, and buying quality assets at reasonable prices. The S&P 500 has created enormous wealth, but the real question is whether small-cap companies could become the next big opportunity over the coming decade. Successful investing is about patience, not prediction.